You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host, Sam Ball. This week on The Investor Way, we have Barratt, Grafton Group, Berkeley, Coca-Cola Euro-Pacific Partners, Melrose, and our US company of the week is Docusign. Sam, should we kick off with Barratt?
Yes.
So Barratt is Britain's largest householder, and they had their full year results out this week. Full year revenue came in at £4.8 billion, which is a 40.7% increase on 2020. And more importantly, it's a 1% increase on 2019. Operating profits were up 64.6% at 811.1 million, which is actually 10% below 2019, with legacy property costs and the repayment of the COVID grants accounting for that. If we break the results down a little further, the full year completions came in at 17,243, which is a 36.8% increase on 2020, but 3.4% lower than in 2019. However, the average selling prices were 325,000 compared with 310,000 in 2020 and 312,000 in 2019. So that is a significant improvement. And this helped offset build cost inflation. Underlying operating margins actually rose to 19.1%, which was up from the 14.8% in 2020 and slightly higher than the 19% in 2019. The group also approved 876 million of land purchases, which amounts to 18,067 plots over 97 new sites. The group finished the year with 1.3 billion of net cash, or 659 million after land creditors, compared with minus 483.7 million in 2020 and 195 million in 2019. Forward sales stood at 15,734, ahead of 2020 and 20% ahead of 2019. And these forward sales were worth £3.9 billion. The group are targeting 20,000 completions a year with gross margins of 23%. Currently, in terms of valuation, the market cap of Barratt is 7.25 billion, with a price to earnings of 11.1 and price to book of 1.31. That compares with a 10-year average of 1.14. Dividend yield is approximately 5% or 5.5%. And overall, to me, these seem impressive results from a sector that we like. Margins are improving and we've got the sort of fundamental and the positive tailwinds for the business. And you see Barratt, as Britain's largest house builder, being a key beneficiary of the housing shortage, and they're also part of the solution to that. Sam, what were your thoughts on Barratt and these full year results?
If Barratt was the only house builder we'd covered in the last couple of months, I'd have been saying they're really good results. But it isn't. And I'd actually say I'm slightly disappointed with the results, just because, I don't know, I just felt the others were better, and only 1% above 2019 and operating profits 10% below. I don't think it compares to the likes of what we've seen from like Taylor Wimpey in person. And yeah, what do you think?
Probably a similar view, actually. I mean, I don't think you could criticize these results, but it's really comparing it with some of its peers in the same sector. And I think I'd probably, out of the ones that we've looked at, it would be Taylor Wimpey. And I think they were very astute with that capital or that equity raise and buying essentially at the bottom of the market and being a bit more aggressive. And now that's looking in the longer term like it's going to pay dividends for them.
Yeah, well, they basically did it at the bottom, didn't they, in hindsight?
Yeah. Which I think at the time you were very critical.
I thought it was irresponsible. Whereas Barratt were a lot more conservative, which is when we covered them about a year ago, I think Barratt was my favourite one of the results we were looking at this time a year ago. And Taylor Wimpey was my least favourite because of that.
I suppose it's the you had the vaccine and the bounce back of the sector, so that's
Yeah,
it's kind of it's been a paradigm shift, really.
And like you said, these are still good results. They're just not as good as Taylor Wimpey's. What's the price to earnings?
Price to earnings is of Taylor Wimpey.
No, Barratt. I mean, we may as well have Taylor Wimpey as well.
Barratt is 11 or just over 11, and Taylor Wimpey is 13.
Yeah, I mean, there's not much in it. Yeah, I suppose that maybe is reflective of the difference. Actually, that probably is fair for both, I'd say. What do you think?
I suppose in the house building sector, there isn't always a huge differentiation. You know, the price to earnings for all of the house builders is generally quite low.
But I think,
and it's cyclical, so it's sort of.
But I think Taylor Wimpey deserves a slight premium over Barratt, and that is all it has, just a slight premium.
Yeah, in terms of how much they fell, so I think if we look at the peak for Taylor Wimpey in the last few years, which was just before the COVID pandemic in March, it was in February 2020 when it was trading at about £2.30 a share. It's now trading about £1.77 a share, which is around 23.5% lower. In terms of Barratt, they were trading at about £8.70 a share in February 2020, and they're down 18% from that now at £7.11.
Right, shall we move on to Grafton Group?
Yeah, so do you want to lead on this?
Yes, so Grafton Group, for anyone who doesn't know, they are an international distributor of building materials to trade customers engaged in residential repair, maintenance and improvement projects, and house building. Company segments are merchanting, retailing, and manufacturing. The merchanting segment is engaged in distribution of building and plumbing materials to professional tradespeople engaged in residential repair, maintenance and improvement projects, and also in residential and new build construction from a network of over 610 branches. The retailing segment operates do-it-yourself home improvement businesses from a network of over 40 stores that supply retail customers with products for the home and garden, and a kitchen retail business that trades from over 5 stores. The manufacturing segment comprises a manufacturer of dry mortar and a plastics manufacturing business. Its brands are Selco, Build Base, Chadwicks, Hayton Buckley, McNaughton, and Panelling Centre, among others. I won't go through any more, but if you go on the website, the list of brands that it's actually got under its umbrella is pretty big. So they have come out with half-year results, and revenue was up 46.1% to 1.028 billion. Operating profit was up 256.6% to 152.1 million. Profit before tax was up 384.8% to 142.9 million. And basic earnings per share was up 403.4% to 48.5p per share. It should be pointed out they were up against very easy comparatives because everything was shut this period last year. The operational highlights included strong performance across the group and a notable record contribution from the Woodies DIY home and garden business in Ireland. They pointed out they've got an agreement to divest the traditional merchanting business in Great Britain for an enterprise value of 520 million. They completed the acquisition of IKH in Finland on 1st of July. They highlighted the good contribution from Starebox acquisition, which performed ahead of plan. And they highlighted the continued progress of their sustainability agenda. It's interesting because the half-year operating profit margin, and half-year cash generation were all at record levels. So although they were up against very easy comparatives, it is the best half they've ever had. The company trades at a PE ratio of 14 when you factor in those half-year results. However, if you look at the performance of the business over 5 years, revenue is basically flat. So between 2016 and 2019, revenue went from 2.5 billion to just under 2.7 billion. And then it's had a bumper year this year. And it's the same story really with earnings per share. They have increased slightly, but not very much. So I think that's why, despite these results, the PE is still pretty low. I think people are looking at it and saying, well, where's the growth actually going to come from with it? Because in terms of the market cap's not massive. It's 3.26 billion, but yes, it's not really really growing that much. Although the share price has done very well, though. Over 5 years, that's up 153%. It's up 74% over 3 years and 88% over 1 year. It's got a dividend yield of 1.07%, but just check to see if those dividends were lower last year. So it might actually, yes, it's probably normal dividend yield is probably closer to 2%. John, thoughts on Grafton Group and these results?
Yeah, they sound, well, easy comparators, but I think overall the company doesn't seem to be going anywhere really. I don't know what the competition or really what the market's like, but it doesn't stand out to me as something where I think I'd be getting a decent return really. Maybe if I knew the sector better, I might have more to say on it, but I don't think they were particularly outstanding results in the longer term. And yeah, I'm not clear where the business is going.
I think as well, a lot of what it sells is basically commoditized. And like I say, it's very difficult to stand out. I'm sort of like, if I look at like businesses that I'd compare it to, it maybe be something like a Kingfisher. And when we looked at Kingfisher a couple of months ago, that did stand out to me. And that was actually at a lower PE as well. I appreciate they're not exactly the same, but I'd be getting Kingfisher before Grafton Group. It just seems they are decent result, but it just seems pretty average to me.
I think it's easier to, I don't know, in my mind to see Kingfisher because I'm familiar with its brands and it's sort of the retail arm of it. I know it does have trade as well, but yeah, Grafton, I just don't feel like I'm probably in a position to comment, but they just don't see, it just doesn't, over the last 5 years, it just doesn't seem to have been really, it's almost treading water.
Yeah, basically.
Is it returning much cash to shareholders?
Well, the yield's only 2%. I didn't see any mention of buybacks, and it looks like they're being slightly acquisitive. They've just bought that Finnish business, and they do have a lot of different brands, but it's growth by acquisition. It looks like it's just, I mean, for a PE of 14, it doesn't seem outrageous. I just think you could probably do a lot better, especially when Kingfisher's at, what was it, like 12 last time we looked. It might have gone up since then.
It's probably, yes.
Let's have a look. No, Kingfisher's still at 12. It's not much.
Okay.
So I'd be going with, and it's got a slightly higher dividend, 2.37%. And as well, it's easier. It's an easier business to understand because if you're in the UK, you will almost certainly recognise the brands.
Yeah.
Whereas I think unless you're a tradesperson, it's probably more difficult to get familiar with the Grafton brands. So I appreciate they're not direct comparators, but I would be going with Kingfisher.
Yeah. If you are a tradesman and you're listening to the show, get in touch.
We'll have them on for an interview to talk about Grafton.
I think I know a tradesperson who might come on.
I know exactly who you're thinking of.
Okay.
It'd be a long episode, that one.
Yeah, be a 3-hour special.
It'd be longer than Connor's interview.
Yeah. On to something kind of related. It's got Berkeley Group, which is a house builder and developer who did cover their full year results at which were out, I think it was back in June actually. But they've had an AGM and a trading statement alongside, and they've said that they're on track to meet full year profit guidance with pre-tax profits of at least 580 million, with the end of lockdown restrictions, London market recovering, and trading outside London being described as robust. They've been saying that they're managing to offset the build cost inflation well. Management expecting to finish the half with forward sales of in the region of 1.7 billion. The group's also updated shareholders that 141 million pounds will be returned earlier than the 30th of September 2022, which they were targeting, although they haven't confirmed whether this will be as a share buyback or through dividends. And that was on the back of those full year results in June, which were pretty good, with a 14.7% rise in revenue to 2.2 billion pounds and operating profits of 502.3 million, which was a 7% improvement on the previous year. And it has over 1 billion pounds in net cash on the balance sheet and further 450 million in available credit. Berkeley Group currently has a market cap of 5.7 billion pounds and trades at 14 times earnings with a price to book of 1.8, 10-year average is also about 1.8. So it's in line with that, more or less. It's got greater London exposure than a lot of the standard sort of or plain house builders, but it traditionally has higher margins as a result, and probably why it's trading a little bit ahead of some of its competitors. But they weren't full year results, just a trading update. Sounds like things are, with most of the sector, going in the right direction, and particularly with a pickup in the London market. Don't know what your thoughts are briefly on Berkeley, Sam.
I don't really understand what they've released the update for. I just think if you're releasing a trading update, it's either because you're going to miss the expectations or you're going to beat them. But to release an update saying you're on track, surely people would assume that if there's just no update. It just seems a bit pointless. And I think as well, especially because I appreciate they're not a pure play house builder, because they do the
brownfield development.
Yeah, they do a lot. So it's not a direct comparison, but obviously all the other house builders we've been looking at have had really, really good results. So I think, again, if you're going to come out with a trading statement just to say, yes, what we previously said, it just seems a bit pointless to me.
We don't need to say much more on that.
No, it's a bit of a slow news week.
So yeah, it is. It was. It made the news just. So again, we've got, well, would we say Coca-Cola Euro Pacific, European? It's US listed, but just
US. So anyone who listened last week, we covered Coca-Cola HBC, which is the Greek Coca-Cola, but it basically operates. It's the Coca-Cola brand, but in Central and Eastern Europe. Coca-Cola Euro Pacific Partners is Coca-Cola in Western Europe and also Australia and New Zealand. So in terms of the countries it operates in Western Europe, they include Andorra, Belgium, France, Germany, Great Britain, Iceland, Luxembourg, Monaco, the Netherlands, Norway, Portugal, Spain, Sweden. And like Coca-Cola HBC, it's got all the Coca-Cola brands, Fanta, Sprite, Monster, and everything else. So Costa as well. Well, everything else that's under that umbrella. So yeah, so it is listed on the New York Stock Exchange, but because it's operating in Western Europe, we're claiming it as a European company. So we're going to cover it. And also it ties in well, actually, because it is, I think because we've already gone through the process of understanding Coca-Cola HBC, it's basically the same business, but in a different region. So they have come out with their half-year results, and they've announced revenue is up 21.5% to 5.9 billion, and all these figures are in euros. Cost of goods sold is up 0.5%, so basically flat. Operating profit is up 71% to 691 million. Earnings per share is up 87.5% to 1.09 euros, and free cash flow is 648 million. By segment, so the segments are split into Europe and API, which is Australia and New Zealand. So Europe revenue for the half is up 10.5% compared to 2020, but down 8% compared to 2019. And Australia and New Zealand revenue for the half is up 15.5% compared to 2020 and flat compared to 2019. They highlighted upward pressure on commodities, and they're estimating that upward pressure in mid to high single digits for the full 2022 financial year. And they mentioned that there's been input pressure regarding the aluminium for the can supply. And they've also talked about the recent increases in sugar prices, although they're saying that they're expecting them to subside next year. And in terms of their hedging, they're 90% hedged for 2021 and 40% hedged for 2022. And what that means is that they've locked in the prices for what they're going to pay for those commodities, or they've locked in the prices for 90% of what they'll need for the 2021 year and 40% of what they'll need for the 2022 year. And for the full year 2021 guidance, they've guided for revenue growth of 26 to 28%, operating profit growth of 40 to 44%, an effective tax rate of 20%, and a dividend payout ratio of 50%. If you use because they were down significantly last year, so if you use the 2019 figures and you treat that as normalized earnings, you would get a PE ratio of 26. And historically, the dividend yield's been around 2.4%. my view is these are decent results. It's obviously a very good company. It's got a Coca-Cola brand, but all the markets it's operating in are pretty developed. And I think, given that, I'm not sure where the growth's going to come from, and a PE of 26 is quite high, especially when you compare it to Coca-Cola Hellenic Bottling Company. I can't remember exactly what that was. We'll call it 25. And that's operating in markets where there's a lot more potential for growth. So it seems like a very good business, but it also seems quite expensive. And I would rather pay less for Coca-Cola Hellenic Bottling Company.
And for reference, what is actual Coke KO's trading at?
Oh, covered it a few weeks ago, so I should remember. So Daddy Coke is trading at 30.
Okay. Yeah.
Daddy Coke does own parts of all the other ones, so it does benefit. It does have, like, for example, some exposure to HBC and stuff like that. And
I mean, you're never going to get Daddy Coke cheaply.
No.
But no, I'd largely agree with you, Sam. I think I'd probably either go for Daddy Coke or Coca-Cola HBC. Probably more inclined at the prices with the potential for growth in HBC. But I like all of the businesses, but that would probably be my pick. And it's UK listed, which for us is definitely a perk.
Yeah, I definitely prefer HBC. It's not really a criticism of Euro Pacific, because it does look like a good business, but it's more the demographics of the markets it's in. It's pretty saturated. And yeah, it's not. Whereas in those developing markets, that Coca-Cola brand could probably go a lot further than where it is as those countries, well, hopefully develop. And also it's at a lower PE ratio as well. I appreciate it is slightly riskier because it's in the emerging markets, and you've obviously got more like currency risk and stuff. But yeah, I massively prefer it.
Yeah, no, agreed there. Okay, so on to our next company, which is Melrose. They've had their half-year results out this week. And for anybody who doesn't know, Melrose is a British manufacturing company that specializes in buying and improving underperforming business. And it actually started life on the alternative investment market, but it's now FTSE 100 listed. We have covered it before, but in terms of these half-year results out, they reported that they'd be better than expected, with revenues rising 5.6% to £3.8 billion, with strong performances in the automotive and power metallurgy.
I don't know. One of them's right.
Metallurgy. We'll go with that. Metallurgy division. Underlying profits rose to £109 million from an £80 million loss last year. But when restructuring, acquisitions, disposal, and amortization charges are factored in, the group actually reported a loss of £151 million. If we break those results down a little further, the aerospace division was down 33% with a revenue of £1.2 billion, and underlying operating profits fell from 54 million to 41 million, despite significant cost savings and demand in narrow body build rates picking up. In the automotive division, revenues were better at 1.7 billion, which represents a 34% rise, with good performances in Europe, Asia Pacific and China. Operating margins were maintained at around 6%. Underlying operating profits came in at 121 million, compared with a 64 million loss in the same period last year. The group pointed out that the global chip shortage was a drag on sales, and they're aiming for a 10% profit margin in the automotive division. Powder metallurgy was a standout performer, with revenue rising 43% to 522 million, in line with the pre-pandemic levels. Underlying profits came in at 60 million, compared with a 3 million loss last year. And that was closer to the 14% margin that they're targeting. In other industrial, revenue was flat at 109 million, with operating profits up to 27 million from 22 million pounds in the same period last year. The funding deficit in the pension scheme was also falling, and that was ahead of schedule. It now stands at 150 million pounds. Underlying free cash flow was 167 million pounds, up from 117 million pounds, and net debt fell from 2.8 billion to 1 billion pounds, which works out at 1.5 times cash profits. The group has a market capitalisation of £8.2 billion with price to earnings of 21. That compares with a 10-year average of 11.6. Current yields just under 2%. So overall, I guess it was a positive update. There's been a significant debt reduction, and that has been ahead of market expectations. The shares were actually trading up on these results. And I suppose it has positive tailwinds with the move towards electric vehicles for its automotive division. But for me, what's worrying is that it's got the significant exposure to aerospace, and with COVID disruption, it's not clear when that revenue is going to recover, and I suppose when and if it is going to. So that's probably why I wouldn't look at the company any more than that. And it's not particularly cheap either. And you've got those concerns. I don't know what you think of those half-year results, Sam.
Pretty similar to you. I mean, they were pretty positive results, I think. The only thing is, like I was going to say similar to you, I mean, with the aerospace, there's just not a fat lot they can do about that. I mean, no one's really spending the money, so there's really very little they can do. But everything else, they can do stuff, they are. I do get concerned when I see the word pension deficit. It is a big red flag for me. It's just something I'd rather avoid. I appreciate it's come down significantly, but I just prefer to avoid them altogether. The debt at 1.5 times cash profits, that seems pretty affordable. I don't think there's any issues with that. So it's a PE of 21, but that's going to be depressed. I was just wondering what like the historic growth looks like. They're acquisitive, aren't they? So that it doesn't really tell you anything, because they, like you're saying, they're on the aim and they buy businesses, don't they? So that explains why revenue's up 10x since 2016. Yeah, it just seems like a difficult business to understand as well, is the other thing.
Yeah, it's
going into the too hard pile for me.
There's not enough that's attracting me to the business, and I think I'd be very concerned about that aerospace division, I think.
There's definitely a few things where I'd say, well, I'd need to dig in and have a closer look at that, but there's just nothing really in there that's making me think that I want to.
Yeah, I think if you got rid of that aerospace division, I think it would warrant closer look, but probably not at the moment for me.
I still don't like pension deficits. Well, it's not. It might be payable, but I just don't like them.
Yeah,
it reminds me of BT.
Okay, we'll have to revisit BT rather. Okay, so shall we move on to our proper American company of the week?
Proper American company, yeah. So it's Docusign. Are you familiar with Docusign, John?
I think I've used the service before, or used the software before, but do you want to give a bit of a background to it?
It's basically software for like getting digital signatures. So if you've done anything to do with like estate agents or solicitors, they're quite keen on it. And the software is pretty slick. It does work pretty well, actually. But what they do is they charge like the estate agents and whoever else like a subscription to actually use the software. So that's where they make the money. So they have come out with their Q2 results. Total revenue was, and all these figures are in dollars, total revenue was $511.8 million, which was an increase of 50% year over year. Subscription revenue was $492.8 million, which was up 52%. Professional services and other revenue were up $19.1 million, which was up 3%. Billings were $595.4 million, which was up 47% year over year. The GAAP gross profit margin was 78% compared to 74% in the same period last year, and the non-GAAP margin was 82% compared to 78% in the same period last year. I'd probably prefer to go with the GAAP margins if I was a shareholder. The GAAP net loss per basic and diluted share was 13 cents. It's 13 cents on 196 million shares outstanding compared to 35 cents on 185 million shares outstanding in the same period last year. So it looks like there's been about, 4% dilution there as well. The non-GAAP net income per diluted share was 47 cents on 208 million shares compared to 17 cents on 203 million shares last year. And net cash provided by operating activities was 177.7 million compared to 118.1 million last year. Free cash flow was 161.7 million compared to 99.8 million in the same period last year. It's unusual that these companies are free cash flow positive, actually, so that is a big plus for them. Cash and cash equivalents were 887.2 million at the end of the quarter, and there are a few points in the slides. So the total revenue growth in the 2019 financial year was 35%, then up to 39% in 2020, and now up to 49%. So the revenue growth is currently increasing, subscription revenue is in line, and of the revenue, 96% comes from subscription, and only 4% comes from that professional services and other. The total customers from the 2013 year to date has grown at a compound annual growth rate of 42% each year. The enterprise and commercial customers has grown at 53%, and that growth is from 54,000 total customers to 1.05 million. And enterprise and commercial customers for the same period, which is 2013 to 2022, or their 2022 estimates, is 4,000 to 148,000. They highlighted that the net dollar retention rate is 124%. So that means that customers are on average spending 24% more each year. And they've highlighted that the international revenue growth is at 71% and now makes up 22% of total revenue. And then they've got a little graph of all the countries they're operating in. So there's obviously like North America, Canada, looks like they're in the UK and a few Western European countries. So it looks like France and Germany, Australia, and then like Brazil as well, it looks like. But most countries they haven't actually gone to yet. So there's obviously a lot of room for expansion there. Now we'll get on to the valuation. So it trades at a price of sales of 33, and that's with a $60 billion market cap. My view is there's absolutely no knocking these results. It's a business where every single metric that I think I saw in there is moving in a positive direction. It looks like there is a lot of opportunity for future growth, but you've got to pay up for it. I mean, I don't like the price of sales of 33. That's very high. I get quite uncomfortable paying that much. But what really would concern me is probably more the market cap, because as a $60 billion company, it needs to make a lot of future earnings just to justify that valuation, let alone to be a market beater. It's difficult to say how big it can be. I guess you could look at something like Adobe and say, well, why can't it be a $200 or $300 billion company? But I think you'd need to have a lot of belief in the optionality of the business and the different things they can do, because it's just like a document signing service. I don't see them as like a $200 or $300 billion company, and I think it's going to be difficult for them to justify a $60 billion valuation. What are your thoughts, John?
I was going to ask you a further question on it. Have they indicated where they might go beyond the sort of the basic service that they have?
Oh, so they've talked about some new product capabilities. So the Docusign CLM:A, which is a new obligation management feature for tracking important terms and due dates and enhanced AI-based search and reporting. And we've also got something called Docusign Rooms for mortgage and Docusign Insight. I don't know what either of those do. I imagine they are going to try and branch out because they have to, just to justify the valuation.
Well, no, I mean, I would sort of agree with you that the numbers are really impressive, and so is the company to date, but it's very expensive. So yeah, I feel like it would be quite a risky business buying shares at the current price. But if it continues as it has with those sorts of figures, then I guess you make the argument, you try and talk yourself into thinking that 30 times sales is maybe reasonable, but I would struggle with that, I think, personally.
Yeah, I would struggle. I guess the only thing you would say is that growth has been accelerating year on year, so that maybe makes it a bit easier. But yeah, I wouldn't want to pay 33 times sales. And for a business, I appreciate that the growth is growing, but for a business that's growing 50% year on year, and it's not just that, but it's sort of business where you look at it and it's like, well, they could go into other things, but like immediately it's like, from what they do now, 60 billion is a lot. So you are I think you're really banking on that optionality and management going into like similar fields. And then how many similar fields can they go into before they're really going up against Adobe? And Adobe is not exactly there for the taking. So yeah, it's very, very expensive to me, I think.
Yeah, fair enough. But a great company
Yeah,
nonetheless.
you can't knock the business. It's just the valuation that I have issue with. So, of the 6 businesses we've talked about today, so Barratt Developments, Grafton Group, Berkeley Group, Coca-Cola Europe, Pacific Partners, Melrose and Docusign. If you had to buy one, which one would it be?
It's quite easy for me this week. I go for Barratt.
I'd also go with Barratt. It wasn't the best house builder we've covered, but I felt like it was probably the best business this week, at least in terms of valuation.
Absolutely.
I suppose you'd argue the best business was Docusign, but
yeah, it's just all about the valuation, though, isn't it?
it is, yeah. And at a P of 11 for Barratt, that seems pretty reasonable to me.
Exactly. Okay. Well, thank you again for listening, and we'll see you again next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.